Traffic lights, non-toll roads, fish in the ocean, and basic knowledge. What do all of these items have in common? They're all free for use. But not all of these items are the same type of good. They are either public goods or common resources. Public goods are neither excludable nor rival in consumption, whereas common resources are rival in consumption but not excludable. Both are available free to the public. But what does this mean? Rival in consumption means that one person's use of the resource reduces another person's ability to use it. The term excludable entails that people can be prevented from using the good. To better understand each type, here's an example of each at school. A public good would be the school bell. It is available to everyone free of charge, and one person's use of it doesn't hinder anyone else from using it. Everyone who hears it enjoys the benefit of being reminded that the period has ended or begun. In daily life, another example would be siren by ambulances or streetlights. Some important public goods include basic knowledge, national defense, and combating poverty. All are available free to the public, and one person's use does not reduce someone else's enjoyment of it. Moreover, at school, an example of common resources would be seats to sit in. It's free to sit in a chair, but your use of the good would prevent another's use of it because the amount available would eventually run out. The same would go for utensils at the hutch and loose-leaf paper. Other examples of important common resources include clean air and water, congested non-toll roads, and the environment. The other two of the four types of goods include private goods, which are both excludable and rival in consumption. The last type includes natural monopolies, which are also known as club goods, which are goods that are not rivals in consumption but are excludable. But we'll be focusing on public goods and common resources and the challenges they pose as free goods. As we've already learned, economists aim for the efficient and equal allocation of resources. Factors like supply and demand, which are dictated by prices, are important in effectively dividing resources. So what happens when items are free, like public goods and common resources? This provides a special challenge for effective distribution of resources, because markets work best for private goods. Both of these free goods involve externalities, which are consequences of industrial activity that affect other parties without being reflected in the cost of the goods or services involved. These externalities can be positive or negative. Positive externalities occur when the consumption or production of a good causes a benefit to a third party. An example of this would be consuming education. You yourself benefit, but there are also benefits to the rest of society, like contributions of ideas. Other examples include farmers' landscaping. Negative externalities, on the other hand, occur when the production or consumption impose external costs on third parties, meaning they're harmful. These include pollution, congestion in traffic, and building new roads. Now that we know that the presence of free goods makes an economic challenge, let's evaluate some of the issues. One issue is the free rider problem. A free rider is someone who gets the benefit of a good but does not contribute or pay for it. Let's go back to school for an example. Say that you're raising money for a fundraiser and donate to support the cause, but also to win an ice cream party. Not everyone in the class donates money, yet they can still all reap the benefits of raising the most money, which is getting the ice cream party. Since more people have the incentive to be free riders rather than ticket buyers, we see problems with resource allocation and dividing up goods, which result in market failure to provide an efficient outcome. In this case, if most students are free riders and do not donate, they would not raise enough money to get the market outcome that they would want, which is the ice cream party. This is similar to fireworks at a local city display on the 4th of July, funding the local fire department, or public education. Everyone, including those who do not pay taxes, can enjoy them. Since public goods are not excludable, the private market is prevented from supplying them because of the free rider problem. So, how do economists go about deciding which public goods to fund or provide? Cost-benefit analysis is the study that compares the costs and benefits to society of providing a public good. This can include roads, bridges, and other public works. This is a difficult job due to the fact that public goods are available to all free of charge. The efficient provision of public goods is intrinsically more difficult than the efficient provision of private goods because private goods have concrete value based on price. So economists make approximations. Cost-benefit analysis can determine whether a city should spend money on building a traffic light at an intersection. Of course, factors such as human safety would be addressed, but this makes the situation complicated since human life is often coined as priceless. If so, then traffic lights would be placed in every corner and intersection, but that is not the case. So in measuring the value of a human life, people look at the risks and how much people would be willing to pay for taking them. This concept also applies to building all sorts of public works and shows how difficult the process is. Another issue that arises is the tragedy of the commons. The tragedy of the commons is a parable to explain why common resources are used more than desirable from the standpoint of society as a whole. It explains why some of our common resources are often misused and exploited because of competition and self-interest, in which groups can get so large that they can destroy industries and deplete common resources. This can eventually lead to environmental degradation. And one example of this is with California's groundwater. California's drought was an issue brought about by the lack of rainfall and the lack of efficient distribution, Stanford even calling it the water free-for-all. These environmental issues arise from negative externalities. Each farmer uses water without care and allows for an abundance of its use, then it reduces the amount that others can use when speaking in terms of effective distribution. However, since some people neglect this external cost and everyone uses too much, this results in the overuse of water or an insufficient supply of it. As mentioned in Mankill's economic principles, governments can sometimes improve market outcomes. Thus, they have the potential to prevent the issue of overconsumption with public policy. Most issues arise because of the absence of property rights or the ability of an individual to own and exercise control over scarce resources. Government involvement to potentially prevent overconsumption can be used by regulating the private market, using tax revenue to supply goods that the market fails to supply, or defining property rights to let market forces like supply and demand act on the goods. Going back to California's groundwater issue, in late 2018, new rules were put into effect to promote the sustainability of groundwater. So, all in all, while these common resources are free and available for consumption, we must be mindful of the limit and availability of these resources, as the dwindling availability of certain free goods does not only affect the nation economically, but also environmentally. Thank you for listening.